Good afternoon and good morning, and welcome to Treasury Strategies' fourth quarter cash briefing for the UK, Eurozone, and North America. I'm Moni Lindsay, Managing Director and Head of the London Office of Treasury Strategies, and I'm joined today on the call by Tony Carfang, Partner of Treasury Strategies. For those of you joining us for the first time, a bit of background on these briefings. Corporate liquidity has long been a significant aspect of the consulting work we do, both for our corporate clients and for our banking clients. And a little over 2 years ago, we became concerned when the subject of cash hoarding kept coming up, particularly after the release of central bank quarterly reports of cash levels, whether the Bank of England, the European Central Bank, or the Fed. So we decided to start digging into and understanding what's really going on at a deeper level. So we continued our ongoing conversations with our clients directly. We began to survey our clients both directly and through our LinkedIn groups. And then we began to follow more closely what was being reported by the central banks and analyzing it and determining what it's saying. And since we began our surveys and these briefings, the focus, and as you know, the focus on cash is really only magnified. Today, we're pleased to share with you our latest findings. And a word before we get started. Our short 30 minutes today does not really give us time for live Q&A. However, we want to take your questions, so please type them into the question box at the bottom right-hand corner of your screen, either during or at the end of the webinar. We'll circulate the answers to all who've called in. And a quick look at the agenda and a preview of the next 25 minutes. Tony's going to share the latest reported cash levels from the central banks and talk to you about what that means. And then we'll both review key highlights from several surveys we've conducted over our LinkedIn groups. And then I'll review what our clients are saying, and Tony will share the advice that we're giving to our clients, and then we'll wrap up. So Tony, let me turn it over to you, and what are the latest reports from the central banks telling us?
Thank you, Moni. Well, we have a lot of new statistics recently out, and if we look at the U.S. first, corporate cash in the U.S. actually increased 2.5% quarter over quarter to a record $1.73 trillion. Looking at the chart, you can see that the pace of the increase has declined over the last 18 months, 24 months, relative to the pace earlier in the past decade, but nevertheless at an all-time high, and the 2.5% quarterly increase was actually higher than many of the recent increases. As we speak to the clients in our corporate treasury consulting practice, it appears that clients were accumulating a little bit extra cash in anticipation of U.S. issues with the fiscal cliff and other regulatory things that were shaping up toward year end. Now, this experience is different than what we see in the UK, where we've now had 3 consecutive quarters of decrease in corporate cash. And in the most recent quarter, ONS reports a decrease of 4.5%, which is actually quite a material drop. However, I'd like to point out that since the beginning of the year 2000, UK corporate cash was the fastest growing of all the regions, having almost tripled over that period. So we may have some reversion back to the mean. We'd actually like to hear from some UK corporate treasurers as to what's on your mind and what you think might be the cause of this. Clearly, this is something that we need to watch, and we're not sure if this is simply mean reversion or if, in fact, there is something happening in the UK different than what we're seeing elsewhere. Now, as we look to the EU, and keep in mind these statistics for the EU are lagged by 1 quarter. The EU, the European Central Bank, reports its cash on a much slower schedule. And if you notice here, cash has been flat for about the past 2.5 years. At 1.93 trillion euro, we see we're at pretty much at the same level we were at the beginning of 2010. this may simply indicate that companies are satisfied with their cash levels, feel that they have enough precautionary cash to meet their needs, to handle their risk, to maintain liquidity even in the face of uncertain funding availability. Now, when we look at all three of these together, we can see that the U.S. and the Eurozone seem to be moving. If you take the big picture, they seem to be moving pretty consistently with each other, which may be a real indicator of the actual global levels of cash. Whereas in the UK, we see more volatility, and we see a pattern very different than what we see in the US and in the Eurozone. And it may simply indicate London's role in the financial markets and how there may be more volatility and more flows because of the more global nature of the London market. Again, this is something we will clearly keep our eye on going forward. Now, over the last 3 quarters, we began showing you the reserve balances on deposit at the central banks, and we pointed out that from virtually zero deposits, banks would not keep excess reserves at the central banks because of the very low borrowing rate. That all changed during the crisis in late 2008. In the upper left, you can see the U.S. Federal Reserve, and bank reserves there went from actually $40 billion up to $800 billion in a period of a month and a half in late 2008. That trend has been going up. The upward trends you see there on that graph represent each of the quantitative easing programs or stimulus programs that the Fed has implemented. And while it's been flat for the last couple of quarters, there was kind of an uptick in the last quarter, and this may indicate the onset of QE3 and some of the Fed's recent operations. If you notice here, the level is 1.6 trillion in idle reserves at the Fed. If QE3 and the mortgage bond buying program and the other programs that the Fed have in place continues through 2015, as they indicated is possible, this number could actually grow to about $3.5 trillion, which is absolutely huge, and we think at Treasury Strategies would have serious repercussions for both our corporate treasurer clients and our financial institution executives. When we move over to the Bank of England, we actually see that the stimulus took place in late 2008 and through 2009. Was kind of quiet for a while and then began increasing again and continues to increase at a fairly steady pace throughout 2012. And again, this probably reflects the stimulus that central banks are pumping into the system. At the bottom, we see the reserves at the European Central Bank did not rise as rapidly initially. There were increases, but you can see from 2008 through early 2011, that move was kind of erratic. However, in 2011, as the Eurozone Chapter 2 of the crisis began to unfold, the European Central Bank, as you can see, stepped in a huge way, with reserves increasing from about 200 billion euro up to almost 900 billion euro. Now, about a year ago, the European Central Bank came out with its special 3-year lending program to financial institutions, which was very well subscribed. However, during the course of 2012, they lowered the borrowing rate on deposits to the central bank down to 0, and we can see about 100 billion euro, either the LTRO being repaid, banks feeling that they have enough capital, or the fact that the 0 rate is simply not clearing the market. One chart that we don't have on here that we want to, that we think we may want to drill down on in the next quarterly briefing, is the Swiss Central Bank. The Swiss National Bank chart would be very interesting because reserves there have increased 6-fold since the beginning of the financial crisis, going from about 80 billion Swiss francs in 2008, up to 490 today. And the interesting thing about this increase is this, it's been fairly steady, but at 490 billion Swiss francs, on a relative basis, compared to the local economy GDP, that number is huge. And before we offer you too many hypotheses about what's happening there, we want to study that further. And of course, we'd be interested in any of your ideas as well. But 490 billion Swiss francs is a number that I think we need to start paying attention to. That increase has been fairly steady and actually accelerating a bit as we moved away from the inception of the financial crisis. So something's happening. Not quite sure. We'll get back to you. When we look at corporate cash as a percentage of GDP by region, and look at it over the last 12 years, in the U.S., in September of 2000, corporate cash was 10% of U.S. GDP. That number is now 11%. It's been flat at 11% for a few years. This clearly counters the notion that you read in the press of corporate treasurers hoarding cash. That is simply not the case. If that were the case, these numbers wouldn't be flat, at least in the U.S. In the Eurozone, we see an increase from 14% of GDP in 2000 to 21%. That biggest jump in terms of percentage took place in 2009 and 2010. And for those of you who tune in regularly to our quarterly cash briefings, that 21% number you'll recognize as having held steady for the last 2 years. Now, in the UK, we started at 29% in 2000. That number actually peaked at 52% about a year ago and has been declining. This 47% that we see today is actually a significant drop from the 50% of GDP that we saw in just the last quarter. So, again, any of you UK treasurers on the line, we'd love to hear what you think might be going on. Now, there's one point that we'd like to focus on here, because we think there are global implications here. At year end, TAG in the U.S., the Transaction Account Guarantee, which is in effect the unlimited FDIC insurance on all corporate transaction deposits, expired. We think this is big and this has global implications. As many of you may have read, estimates range from 1.2 trillion to 1.4 trillion of cash moved into U.S. commercial banks to take advantage of the special insurance guarantee that has basically been in place since very early 2009. This represents the first major unwinding of a post-crisis remedy. And there may be some messages in here and in how this expiration unfolded that might tell us how things might unfold elsewhere as we move further and further away from the crisis and these remedies begin to be dismantled. What was expected was that when deposit insurance got scaled back from unlimited down to $250,000, there would be hundreds and hundreds and hundreds of billions of dollars of cash flowing out of banks into other instruments, and primarily money market mutual funds. But what we see here is during the fourth quarter of 2012, leading up to the December 31st expiration, deposits at U.S. banks actually increased. They did not decrease. So in the face of losing deposit insurance, deposits still went into the banks. This is true in all categories of banks that the Fed measures, large U.S. banks, small U.S. banks, foreign subsidiaries or U.S. subsidiaries of foreign banks all experienced deposit inflows, and deposit inflows at a relatively high rate of 4% during the fourth quarter. This may indicate that either the marketplace believes that banks are healthier and don't need the deposit insurance, which would certainly be a very good sign, or it may indicate that corporate treasurers believe that this money is guaranteed anyway, implicitly by the government, and it really doesn't matter. Now, we did see an inflow into money market funds. So, there were some monies, in this case 140 billion, nowhere near the 1.4 trillion that the money fund industry lost when the bank guarantee went into place in 2009. So there are some corporate treasurers who moved, and underneath these numbers, you actually see of that 5.5% increase in money fund assets, there was a 7% increase in Treasury funds and only a 3% increase in prime funds. So the message is still one of safety, but certainly a willingness to take on or to diversify out of the banking system, at least with respect to that $140 billion. Now, those are the numbers, those are the facts. But Moni is in touch with Treasury Strategies corporate clients every day, and we survey them regularly. What are some of the highlights that you see there, Moni?
Okay, Tony. Well, we actually conducted 2 surveys on 2 of our LinkedIn groups, and both of the surveys were around what are the most serious issues that corporate treasurers anticipate in 2013, and then what are the most significant financial regulatory issues. I think the interesting thing is that we got over 600 responses globally to these surveys and well over 100 additional comments and ongoing conversations. So let's share with you. The first we asked what did they consider the most serious issues for corporate treasurers, and we gave them a multiple choice, so these actually add up to 100. But the one that came out with by far the greatest numbers was the economic outlook and interest rate levels. And everyone feels like it's hard to get a handle on the economic outlook, and it's really not helped by the political environment, particularly when you look at the fiscal cliff in the U.S. and the Eurozone crisis in Europe. Now, there's an increasing awareness that regulation will have an impact, but for treasurers, that impact is really unknown, and we'll look at that more when we look at some of the quotes from some of the respondents. I think we found one of the most interesting things here is that currency and counterparty risk came in third, and based on the conversations we've had with our clients for the last, well, since we're now into our 5th year of the crisis, which was kind of scary when you think about it. But since the crisis, counterparty risk has always been top of mind. But we think what's happened is that really most of you have addressed it. You've put policies in place that actually help you manage that counterparty risk, and you've put processes and technologies in place that help you monitor it and manage it. So while it is a critical piece, an issue for everyone, I think most people feel like they have it under control. And what they don't feel like they have under control is certainly what's going to happen in the economy and what the impact of regulation is going to be. Now, there were certain respondents that also were quite concerned about capital, and we'll look at some of those quotes as well. So, and those that are concerned about the availability of capital feel like that's also another area where they don't have a lot of control. Now, if we go to the next slide, this really talked about and we asked our Financial Services Regulatory LinkedIn group the question, what did they consider the most significant financial regulatory issues of 2013? So here, again, you can see by far close to 60%, really see capital, liquidity, and funding regulations to be implemented as the most serious issue. There was some welcome news this week for banks, and that for the Basel III liquidity, there's going to be some relaxation of the requirements, and it's going to be extended from the implementation. Instead of beginning in 2013, will begin in 2015. There's certainly a lot of concerns around derivatives and the capital markets regulations and transaction taxes and shadow banking, which is probably least understood. So Tony, what do we see on the horizon that would significantly change the deposits landscape?
Well, Moni, as you already alluded to, the change in the rollout of the liquidity ratio in Basel III and possible changes in the net stable funding will probably improve availability of capital for corporate treasurers and improve the health and profitability of the banks. We think that'd be a very good thing. We want to keep our eye on that as this rolls out, and we're expecting another announcement on the net stable funding plank of Basel III coming up in the first quarter. I think the health of the banking system, we're seeing signs of things apparently getting better. When European banks are beginning to pay off some of their loans to the European central banks, when the U.S. weans itself from deposit insurance and there are no crises as a result, we think that's a very good sign. We want to keep our eye on that, obviously. On the bottom left, changes in monetary policy by the central banks continue to be top of mind for us. There have been trillions of dollars or euro or pounds or whatever currency of intervention by the central banks. We think that the successful weaning of the TAG program in the U.S. might send signals to other central banks that it may be possible to begin to dismantle some of the artificial interference that they've had in the markets. We want to keep track of that. And then finally, the next chapter in money market fund reforms, the FSOC in the U.S. has 3 proposals out for comment. Comments are due next Friday, which, by the way, will be the 31st anniversary of the founding of Treasury Strategies on January 18th. We will be commenting on that. Actually, we have a series of 4 different letters taking different angles. By the way, if you would like copies of those letters, just drop us an email, and we will share those letters with you. IOSCO has also come out with some recommendations for additional regulation. This is one to keep an eye on because of the prominent role the money market mutual funds play in the corporate liquidity space. Now, Moni, I'd like to go back to you again with some deeper insights into the in-depth discussions you're having with our clients.
Sure, Tony. And here we're sharing some of the comments we got back from the surveys that just recently reviewed with you. So here's, in terms of the most serious issues, they're very much aligned clearly with results. And the common themes are the impact of regulation and the availability of capital. So worth noting is this one quote that says, regulation, it's an unfamiliar territory, and so it's very difficult for treasurers to estimate the changes it will bring. So we're seeing our corporate banking clients having more conversations around expected impact, because those are the conversations that are going to provide the most information for corporate treasurers. Others feel that they can get their hands around FX and interest rate risk, but not the availability of capital. And this last quote, one of these last quotes, sees a lot of work involved and the importance of focusing on and adjusting systems and processes. So always when you have so much uncertainty, the more you can take care of what you have control over in terms of your maximizing your working capital, you're controlling your interest rate and your FX risks, and you're controlling and managing your counterparty risk, the more flexibility you'll have to deal with what's unknown. Now let's look at some of the quotes we got from the respondents around the regulatory issues, financial regulatory issues. One of the most concerns was around changes in derivatives and the capital markets. And this interesting quote says that it will drive changes in the coming years, particularly in how corporates are funding themselves and how banks will operate in that environment. And this particular respondent said it's interesting, they don't think this will affect or make changes in 2013, but certainly the regulatory changes in 2013 will be felt beyond then. And then a couple of these other quotes, it says they're concerned that it's causing distractions in the economy, and concerns that unregulated and underlying questions around, and this is really around shadow banking, and our regulators shifting the risk to unregulated entities. And we think that's certainly a significant concern around shadow banking. So Tony, what advice are we giving our clients?
Well, thank you, Moni. We actually work with corporate clients and financial institutions around the world, And we have a couple of key themes that emerge from our consulting work, and one is around Treasury technology. At Treasury Strategies, we have been very busy in helping our clients select and upgrade their Treasury technology and implement their Treasury technology. And what we're finding here is that global visibility of cash and global visibility of counterparty risk has changed quite a bit over the course of the crisis. And where it used to be acceptable to have, real-time visibility of 80% of your cash and 1 or 2 or 3 day visibility of the remaining 20%, now the minimum table stakes here are 99.9%, and our clients are wiring themselves to be able to do that. That's the first step in moving their technology to a Treasury 3.0 environment. We suggest that our clients strengthen their Treasury organizations and processes. Over the course of the crisis, as important as Treasury is as the nerve center of the firm, they've been faced with budget constraints, and frankly, we are beginning to see a lot of our clients with Treasury systems that are, and Treasury practices and organizations that are stale. They've lost intellectual capital over the course of the financial crisis as there have been turnover that has not been replaced, and now's the time to put that back in place. Particularly if we're in the early stages of what could be a major recovery, you absolutely need to be prepared to that. Taking advantage of the current interest rates. The central banks are saying we're going to have low interest rates as far as the eye can see, but I got to believe that as they begin unwinding their bloated balance sheets and economies around the world begin to pick up steam, we could actually see spiking long-term rates much more quickly than is currently being anticipated. Analytics. Sort of the second step of Treasury technology in your evolution and we're working with a number of clients to do this, is to be able to stress test, to be able to simulate their environment on multiple scenarios. So a lot of analytics are now being built either in conjunction with the Treasury technology, in the Treasury workstations, the Treasury management systems, or they're being built separately but feeding data from those systems. We believe that analytics is really the third generation of Treasury management, and so the final point that Moni is work with number of clients to create a Treasury 3.0 roadmap and actually move from the end of the second generation of Treasury to the third generation, where Treasury will be the financial and information nerve center, the interface across operating departments of a company, as well as all the external stakeholders, be they regulators, investors, security analysts, banks, credit providers, whatever. That really requires a massive leap in technology employed by Treasury. So in a nutshell, and again, it's not one size fits all, so please call Treasury Strategies so that we can customize this for your organization. Moni?
Yeah, thanks everyone for joining us again for our 10th quarterly cash briefing, and look for our invitation to the briefing next quarter. Note, we have an upcoming State of the Profession on the 29th, where we'll talk about what we saw in 2012 and the issues and emerging trends we see for 2013 and beyond. Also, for the corporates on the line, be on the lookout for our next survey and take a few minutes to complete it. Your input is very important to the ongoing assessment of trends and impacting the cash levels. Thank you for your questions. We will answer and circulate to all who registered, and we'll also send you a copy of the report and a recording of this session. We encourage you to look at our website for further articles and commentary, and to reach out if we can be of help. Thank you very much.